Welcome to Ikura. This is 95% down in 2 weeks. Don't do what we did. Actually, I'm not 95% down. Z is. I'm only 70% down. Much better.
Very much better. You're going to owe me lunch.
Bring it. Happy to.
To make this challenge more fun, Ming and I are betting each other lunch every single month. And at the end of this, the winner, the person who has more value in their account than the other, is able to put up a photo of themselves doing anything they want in the other person's bedroom. Like Ming said, I am down 95% in my portfolio in 2 weeks. This has been an incredibly difficult and painful lesson, and we want to share some of the things we've learned and mistakes we've made in these couple of weeks.
My first mistake that I made was I definitely held my puts way too long. I should have taken profit. Looking backwards, everything I guess is clearer, but I wish I had just sold my puts as soon as they had doubled in value. I think I was too stubborn, spending way too much time sort of like in disbelief, hoping for things to make sense when I should have just been more opportunistic about changing my positions. If the market just keeps going up and up and up, I shouldn't, stick to my puts and be like, no, come down. I should have just switched sides.
One of the first mistakes that I made was going along with the market sentiment. And especially even after the market had made big moves, I had the expectation that it would continue doing the same thing. And I always bought at the wrong time because as soon as I bought, the market went in exactly the other way.
Over to me. Mistake number 2 that I made was the fact that the market was going down and I threw in all my cash. I think that at one point I only had $29 left in my trading account, and everything was in the Standard & Poor ETF puts and Zoom calls, and everything was going down. It really drives home the point that these options are not like stocks that you can just hold for, eternity. It's really scary actually when all your money is in these options, and every day you just see the value decrease. Especially around this time, I was like, I was scouring the internet for like clues on what to do, and I kept coming across articles about how Warren Buffett has like nearly $200 billion of cash, and he's just like waiting to buy stuff. And I was like, oh, I should have kept some cash. So that is a big mistake, and I hope I'm never in that position again.
Another mistake that I made was not understanding how implied volatility affects option prices. And this is simply because we're absolute noobs at trading options. And we don't really understand what affects the price, because we think that if we have an option, it's worth a certain amount of money, and if the stock price goes up or down, then the option goes up or down. But that really is not the case, because there are other things that affect option price. One of these is implied volatility, and it means how likely a stock price is going to change. And if the implied volatility is high, your options or your puts are worth a lot more money than if the implied volatility is low, simply because the chance of you getting into the money with your options is much higher if the volatility is much higher. Not understanding this at the very beginning allowed me to buy puts in the market that were at their highest price that they had ever been.
Big mistake number 3 that I made, well, for the most part, I use Reddit a lot, and I love the content on Reddit, and I actually usually think that the crowd knows best, but I definitely think that there was some very compelling but ultimately bad Reddit posts that I took as a compass for my option directions. I remember one of them talked about how as soon as the Fed starts printing money, the market is going to go up, but you have to beware IV crush. His point was that as soon as the Fed starts printing money, all the options are going to lose value because there's going to be much less volatility. That may have been right in the long run. Maybe next week it's going to be right, but 2 weeks ago that was like completely wrong. And that was one of the big reasons why I did not buy calls when I wish I had. I think that, like, honestly, nobody knows what's going to happen tomorrow or the day after, and it's all it's all about best guesses. And so sometimes you listening to, an expert say what the market's going to do tomorrow could be just as valid as your own intuition, because nobody knows.
We did not understand at all how theta decay would affect options. Options have a limited shelf life, and over time, options will decrease in value with the amount of time that they have left. And the only thing that keeps them rising is if they are getting more and more in the money. Us not understanding how each and every single day an option is worth less unless the stock price is moving in the direction you want is really something that we didn't understand in the beginning and is really important to know. Over the last 2 weeks, Ming and I have been learning a lot about options, and this has now led us to have a lot of big strategy changes in the way that we approach options. And we want to share some of the learnings that we have with you.
I've come up with several guidelines for how I want to play my next moves. I'm calling short of calling them strategies because they haven't been tested. They might lead to even more ruin, but I think I'm going to stick to these couple rules, at least for the next week, until they prove to be unhelpful. Number one, I'm always going to keep a bit of cash. Always. I don't know whether, you can decide whether you want to keep like 10%, 20%, but I don't want to be in that situation again where I have all my money invested and everything going down and no balance or no buffer to like make my next move. I think the great thing with trading options is that it is so risky and the rewards are so great that as long as you can keep a small pool of cash, you can always make it back. But if you have nothing, there's nothing you can do, because a lot of options have a minimum price. They're going to buy options at strike prices that are so far out of the money, so far beyond what the current share price is right now, that highly likely you're going to lose all of it. So that's why you always want to keep a minimum buffer of, at least in my case, I'm hoping to keep at least $1,000 of cash in my account.
One of the ways that I am changing my strategy is how to hedge my bets in options. And this can come in lots of different ways, but I think it's fundamentally important to know how to cap your losses. And that is something that you should learn very early on as an option trader.
The next guideline I'm going to keep in mind whenever I buy an option, whether it's a put or a call, is to be willing to spend a bit more for an option that is not so far out of the money. So a small anecdote, I recently came across a post on Reddit from this lady who made something like literally $700,000 buying Amazon calls in a matter of 2 weeks. And when I looked at the moves that she made and compared them to the share price when she made them, she bought very expensive calls, but the strike price was never more than 10% off from where the share price was at the time. So in reality, she wasn't really making such huge bets that the stock would explode. She literally, her bet was saying, I bet Amazon is going to rise in share price by 6% over the next 30 days. And as soon as it did, she sold and bought more calls. So similarly, I'm going to try to buy these calls and puts that are closer to the current share price. It's going to cost more, but I think that you can still make a lot of money that way.
Another way that I'm changing my strategy is to research more about the strategies in options themselves. There is a lot of literature out there on the internet, and I read none of it before I started playing in options. And this is really a huge mistake, because if you don't understand what a spread is, a straddle, a strangle, well, it's very likely that your strategy is not going to be better than people that have been playing options for a long time. So one of the most important things is to understand the strategies available to you so you can pick the one that works for you.
Finally, my third guideline is to play both sides. Previously, I was stuck being a bear holding puts for about 2 weeks, always telling myself, no, trust me, it'll go red, it'll get better. And while the market was just like zooming, I don't want to be in that position again. I think I've come to the acknowledgement that in the long run, the stock market will always go up. In the short run, like say the next 1 or 2 weeks, I have no idea whether it's going to go up or go down. So I'm better off just buying both calls and puts and timing when I'm going to sell these options back into the market. So for example, last night I bought puts on SPY, but calls on Facebook. They are both betting on different things to happen, in fact, opposite directions. But I'd rather be opportunistic when the market moves than be someone who has to tell myself to hold my diamond hands forever until everything goes down to -0, basically.
Hope you've learned a little bit about option trading. Thank you so much for watching, and please make sure to like this video. It really helps the algorithm help other people find us.
If you like what you saw, please subscribe so that you get notified when we release our next video. On April 30th, one of us is going to treat the other to lunch. Whoever has the higher portfolio value will be the treater, and whoever is losing will get a free lunch. The last time I had to buy Z lunch, and literally the day after lunch, his portfolio raced ahead of mine. And so it wasn't a very happy lunch for me. But we'll see how it goes. Check out ikura.com to follow along with our trades, and see you next time.
See you next time.